What is up, guys? Humphrey here. Welcome back to my channel. So back on the 1st of this year of 2021, I actually made a video about my Roth IRA and its holdings. And at the time, part of my portfolio was invested in ticker symbol BNDW, which is an international bond fund. That video ended up doing pretty well on my channel, and actually I got a lot of comments from you guys that called me out for investing in a dying asset class. Some people called me a boomer, and if you ever want to make someone older than the age of 30 reconsider their life choices, just call them a boomer. So that's what I actually did. I started to examine whether or not bonds were a good choice for my Roth IRA, either with a bond fund like the one that I was invested in, or just buying straight up treasuries. But truth be told, I started my Roth IRA around the age of 26 or 27, and the allocation that I went with to begin with was 40% in US equities, 40% in international equities, and 20% in bonds. Now, at the time, I thought this was a great allocation for my risk and return profile. It was weighted heavier in equities in both the US and international stock markets, and it was invested through ETFs. I had set out to be moderately aggressive, but still have some fixed income assets through the bonds that I held in my portfolio. But the thing is, that was then, and today the bond landscape looks a lot different. So in today's video, I'll give you a quick recap on what a bond is, since the details are always a little bit fuzzy for me and some of my friends. We'll also talk about the current bond landscape and why they're no longer a great choice for someone who is a younger investor. And lastly, I'll also share with you my opinion on how you should be thinking about bonds in your portfolio for the best returns moving forward. Before we start, a large percentage of my viewers are not subscribed, so if you do end up enjoying this content, make sure to subscribe. It's free and you can always change your mind. Also, I just wanted to add that this video is not sponsored. Most of my YouTube videos are not sponsored, but I do have a free Sunday newsletter called Hump Days. It goes out every single Sunday, so if you'd like to subscribe to that, the link for that is in the description below. All right, so what is a bond? Now, simply put, a bond is a loan that you give to someone else in exchange for interest. So if you've ever eaten dinner out with your friends and you pay for dinner and you have everyone like Venmo you or pay you back later, essentially what you're doing is actually creating an informal bond between you and your friends until they pay you back. In the informal sense, you generally don't charge your friends interest for that loan, and you're okay fronting the money because you know that they're just going to pay you back hopefully within that same night. Now, in the investing world, bonds are a little bit different. So bonds are actually issued by companies, governments, and even local municipalities. They issue bonds, you lend them your money, and at the end of the agreed period, you actually get your money back. And during that agreed period, you also get regular interest payments. So in that regard, it's actually a fixed income product. And what that means is that you can generally expect a fixed amount of money in return for your investment. Now, the main thing you need to know about bonds is they have what's called a quote yield, and that's simply the interest rate or the return that an investor can expect when they're actually investing in a bond. When the US government issues bonds, they're called treasury bonds, and the yield that accompanies it is actually called the treasury yield. So right now, the 10-year treasury yield is actually around 1.361%. And so that means if you put $10,000 into a 10-year treasury bond, you can expect to get around $136 back every single year, in addition to getting the $10,000 back at the end of 10 years. The interest rate is pretty low because they are virtually risk-free investments. Basically, the only time that they are going to have risk is that if the US government collapses, they will basically default on that treasury bond, which means you won't get paid. But the US government has never collapsed, so they're virtually risk-free. Okay, so obviously bonds aren't really a great choice for your portfolio anymore, but you still need to know and understand the history of why investors liked having bonds in their portfolio in the past. One of the conventional methods of asset allocation would be the rule of 100, and the rule of 100 works in a really simple way. You take your age and you subtract it from 100, and the remainder of what you have there is how much of your portfolio should be allocated towards stocks. So if you're 20 years old, you take 100 minus 20 and the remainder is 80. So your portfolio would consist of 80% stocks and 20% in bonds. Now, if you are 40 years old, that number would be 60% in stocks, since 100 minus 40 is 60, and so on and so forth. The basic principle there was that as we get older, we have less of an ability to actually earn income, and our risk tolerance really changes quite a lot. So we want that large amount of fixed income to be present the later and later that we get in our lives. But nowadays, the rule of 100 is a little bit outdated. In fact, with bond yields being so low recently, it doesn't make sense for someone who's young, and I would say young being someone less than the age of 35, to even consider having bonds in their portfolio anymore. Now, to give you guys some context, the stock market has actually averaged 7.57% since 1920, adjusted for inflation, and the historical return for the bond market is anywhere between 3.5 to 6% since 1920. Now, don't get me wrong here, but both of those are pretty decent returns in our lifetimes, but but the stock market has really outperformed the bond market, especially as of recent. Now, Vanguard has a really great tool that I'll link below and bring up on the screen right here, but we can actually view the historical performance of each type of asset allocation over time, and I find this stuff really fascinating. So at the end of each spectrum, if we invested in 100% fixed income, for example, we would actually have an average return of 5.33%, with the best year returning 32.62% and the worst year returning negative 8.13%. Now, if you've been in fixed income for the past 94 years, 14 out of those 94 years would have been losing years. Now, if we invested in 100% equities, we would have actually seen an average return of 10.29%, which is almost double what we would have seen in the 100% fixed income portfolio. The best year in this case would have been 54.2% of a gain, and the worst year being down minus 43.13%. Out of 94 years, 26 years would have been losing years. So that's kind of an interesting contrast to make between the 100% equity and 100% fixed income portfolios. Now, just for fun here, let's actually look at the 50% equity, 50% fixed income portfolio, and you can actually see that the average annual return here is 8.29% over the past 94 years, which is pretty good as well. The best year in this case was 1933, and it returned 36.37%, and the worst year was returning around negative 23.49%. Now, you would have 18 out of 94 years that you've had this portfolio with a loss, so clearly more of these years are actually going to be losers just because you have more equities within your portfolio. And as we all know, the stock market is going to be a lot more volatile than the bond market. But the point I'm trying to make in this video particularly is that bond yields have fallen dramatically over the course of the past 10 to 20 years. Just looking at this chart from CNBC, you can actually see the 10-year treasury has been on a steady decline ever since the 1980s. These days, it doesn't really make sense for a younger investor to invest in bonds because of how much time they have until retirement. So let's say you actually invested in that 100% equity portfolio that I'll bring up on the screen again. Well, even if you lost 40% of your portfolio in the worst year or half your portfolio in, say, the year 2008, you at least still have 30 plus or more years in a career to earn that money back and continue to invest it. And this is basically what I realized in my own Roth IRA after doing some introspection. My goals right now are just simply capital accumulation, and I don't really plan on stopping to work anytime soon. So in my case, there's really no need for a low risk fixed income asset within my portfolio because right now I don't really anticipate needing that fixed income. I would even say it's a worse choice for me, especially in a Roth IRA, since a Roth IRA allows you to have tax-free gains on your investments. The potential of my Roth IRA was being wasted on fixed income assets. So what I just did was I just sold off the $4,000 or so that I had in my bond fund and just redistributed them among the other holdings I did have, which were in equity ETFs. So right now, my Roth IRA is 100% in equity ETFs, mostly the total stock market, the S&P 500, as well as some of the international equities. Now, another fairly popular investment out there are actually target date funds, but even these funds, which I want to actually bring up, are actually quite conservative and don't call for more than a 6 to 10% allocation of bonds, especially if you're young. For example, even the Fidelity Freedom 2060 Target Date Fund, which is if you anticipate retiring in the year 2060, you would basically buy this fund right now, that even has an allocation of 6.81% in bonds and the rest is in equities. As you near that retirement year though of 2060, the allocation will change over time to include more fixed income assets, but since these are all one size fits all funds, it's no surprise that they already do include some bonds even for the younger investor. Target date funds in general are pretty conservative investments and they need to have a conservative strategy that basically fits or encompasses a lot of people. Okay, so what if you aren't invested in a target date fund and you're thinking about your portfolio? How should you be thinking about bonds in your own portfolio? And this is where I think it can actually get pretty fun. The main fundamental thing that we should be asking ourselves when we're investing is figuring out what our risk tolerance and what our goals are. For example, if my goal was to retire tomorrow and jet set around the world, I probably would allocate more of my portfolio into fixed income products. That's simply because if my goal is not to work anymore, I would want to balance out my portfolio to make sure I'm not taking too much of a risk of going broke. In that sense, fixed income becomes way more important the more that I just don't want to work. Another consideration to make is to figure out what the bond market looks like. So let's say you're all of a sudden looking at the bond market and the yields are going up back to pre-1990 levels. And that's when the consideration needs to be made for adding more bonds back into your portfolio if it starts to make sense. So these days, with the way that the bond market is actually going right now, an easier general rule to think about is the rule of 120 to determine your asset allocation. So earlier we had the rule of 100, but these days 120 is a much more reasonable approach. So if you took your age and you subtracted it from from 120, that would be your allocation in stocks. Now, before I get some of you guys saying, oh, but Humphrey, I'm only 16 years old, I should have 104% in stocks. Well, if it's over 100%, then you're just gonna have 100% in equities. But let's say you're at the age of 40, you would take 120 minus 40, so you would wanna have 80% in stocks and 20% in bonds, and I think that this allocation is a much more reasonable approach. Another option, if you do want fixed income, is to actually buy dividend stocks. So if you can find a dividend stock that pays higher than the 10-year treasury, say a dividend stock like Coca-Cola, you'll actually get a 3% yield on your money, and you can also get to take part of the appreciation of that stock as well. Since Coke stock has been paying quarterly dividends for over 50 years now, it's pretty likely that they'll continue to pay that dividends. Now, if you had invested in Coke 5 years ago, that initial investment would also be up 19%. If you do have a Roth IRA, I personally would much rather have dividend stocks than bonds, especially the younger that you are. As your age approaches 35, 45, and 55, that's when it's a good time to consider weighing more of your portfolio in fixed income assets. And even if you are on the elderly side, let's say you're the age of 75, if we have a portfolio with 60% stocks and 40% bonds, we could have the worst year of our lives in the stock market. According to Vanguard, we would lose around 27.58% of our portfolio. So hypothetically speaking, let's say you reach the age of 75 years old and you have $1 million in your retirement account. Even with a minus 27% return in the market, you'd still have a little bit more than 700K left. Now, right now, the life expectancy in the United States is around 79 to 80 years old. So I would like to think that 700K is still enough for someone who's 75 years old, unless they're balling out on yachts every single week or buying Dogecoin. Okay, so my final thought today to basically help you figure out your asset allocation is to try to identify your risk tolerance. And you can do so by taking a free investor questionnaire online. I'll link a free one for you guys in the description below, or you can ask yourselves the following questions. Questions like, if my portfolio were to drop 30, 40, or 50% in 6 months, would I be okay? Now, if your answer is, yeah, I'll probably be okay, then maybe you can be a little bit more risky. You can also ask yourselves questions like, do I have consistent enough of an income that can stomach volatility? Do I have multiple streams of income? Is my investment time horizon short or long? Because that's going to affect how you invest as well. Lastly, you can figure out, am I a more naturally aggressive or more of a naturally conservative type of investor? Once you figure out how risky you are, you can see if your asset allocation matches your risk tolerance and time horizon. And folks, this is what investing is all about. What I'm also going to do is leave a really long list of questions in the description below as well. And after you ask yourselves those questions, you can kind of look at your portfolio and figure out if it actually matches what your risk tolerance is like. All right, so I hope that you found this video helpful, and let me know in the comments if you do have any questions. Also, make sure to like this video, subscribe to my channel for more videos from me, and hit the notification bell because then you can get notified whenever I drop a new video. Make sure to grab some free stocks in the description below. It does really help this channel out. So if you do use any of those links, I do appreciate you and thank you. And lastly, thanks to all my Patreon supporters. I appreciate you guys watching me and always being there. And I will see you guys in the next video, which will hopefully be in a few days here. Peace.